Hi, everyone. Uh, Thank you for taking out time and joining us for this webinar today on steering through the market turbulence. As a guest speaker for today, I've got Resham Jain, who manages the mid and small cap strategy at DSP Mutual Fund. And what basically we will try and talk about today is first I'll start with a brief update about what's happening in the markets, and followed by that, Resham would basically talk about their views on the mid and small cap equities and overall markets as such. And after that, we will have I think good enough time to run through the questions from all of you as participants. So I'm looking forward to have a pretty engaging session with Resham, so that all of you can basically benefit out of this conversation as such. And just a couple of things to kind of keep in mind, and if you have any questions, feel free to post them using the Q&A tab, and we will have, like I said, we will have time to address them once Resham is done with his presentation. And with that, I'll just get started. So just to give you all a brief overview about the Morningstar Investment Management Group. So basically, we are a global investment management firm operating out of 3 investment hubs, that is Americas, EMEA, and Asia Pacific. Collectively, all put together, we are basically looking after around $265 billion worth of assets under advisement and management. We have got a strong team of 90 plus investment professionals, ranging from research analysts to portfolio managers, specialists, and so on. And the overall investment management piece that we basically look after is something which is governed by strong structure of committees, ranging from asset allocation committees to manager selection and portfolio construction, so that the idea is that the investment principles on which our strategies are kind of based on are linear across all the investment hubs, and India is basically part of the Asia Pacific hub. With that, I'll just move on to the quick update around markets, what's happening in the markets. I'm sure all of you are kind of pretty much glued to or keeping a tab of what's happening in the markets, not just India and but also the global markets. So what we have seen on a year-to-date basis is that definitely the Russia-Ukraine situation has escalated. A lot of tension in the global markets, plus the energy supply constraints have put in a lot of pressure on the energy prices as such, and all of that is leading to or fueling to a decadal high inflation rate in the developed markets. And then most of this is something which is kind of getting transpired into the equity markets, because if you look at the year-to-date performance of, say, global equities versus Indian equities, definitely you can clearly look at the difference in terms of the outperformance by Indian equities versus that of global equities, and not just on a year-to-date basis, but the gap is also visible on a one-year performance, where Indian equities have done reasonably well as compared to both EM and DM. To an extent, this kind of heightens some amount of risk on the valuations front, and which I'll talk about in the later slides. But just a broad overview about even on the commodity front, basically what we are seeing is that crude oil price have now seen some bit of correction after touching its recent peak, given that there are a lot of slowdown and recession concerns in the global market, plus the kind of subdued demand that is coming in from China has also impacted the crude oil prices. On the other hand, if you look at the the flows, that is FPIs and DII flows into the Indian equities, FPIs continue to have been selling Indian equities by and large. Lately they have put in money into the Indian equities again, but if you look at the 1-year number, they have basically pulled out roughly around $28 billion worth of assets. On the other hand, the domestic investors have basically put in a lot more than the overall money pulled out by the FPIs, and the 1-year number basically stands at roughly around $40 billion worth of inflows. And on the sectoral front, if we break down BSE 500 index and look at the sectoral performance on a 3-month and on a 1-year basis, what we are seeing is that cyclicals, have seen, and in consumer defensive have seen a strong performance lately, driven by particularly, when we look at cyclicals, the auto sector by and large has benefited with fall in the industrial metal prices and easing of the supply concerns around semiconductors. So that is what is basically supporting autos. Financial services has been doing well, given that the credit offtake has started to see a double-digit growth number, and also healthy book which is kind of building towards the corporate and retail lending. Apart from that, healthcare is something which has taken up a beating due to the expectation of subdued earning growth momentum, which is kind of getting reflected into the healthcare company prices as such. And by and large, basically what we are seeing is that some of the inflationary or high raw material price concerns that we had kind of witnessed for the June quarter in particular is now expected to kind of subside in Q2 of FY23, given that the commodity prices have kind of peaked and they have seen lately they have seen some bit of correction as such. So that is what is expected to help companies improve or show some better numbers on the margins. Moving on to the breakup on the developed market front, basically what we are seeing is that UK and Japan in particular has basically done well in recent times, and of course Europe on the other hand has seen a major fall, obviously because of what's happening around Russia, Ukraine, plus the effect of high energy prices and supply constraints, and obviously the high inflation and aggressive tightening by the ECB and all of that. So European equities have seen a much sharper correction. In fact, this correction has basically made European equities kind of attractive from a valuation standpoint. And on the developed market front, UK and European equities is where we are seeing a lot of attractiveness kind of building up. On the emerging markets front, again, if we look at the overall emerging market performance on a 1-year basis, I think the performance has been by and large dragged down by what's happening in China. Earlier, it was the tech crackdown by the regulator. Then there was this real estate default related concerns, and after that there were recurring COVID related lockdowns, which has impacted their local demand. So all of these factors have basically led to a sharp underperformance by Chinese equities versus global equities. Eventually, this again is basically opening up an attractive valuation gap in favor of China, given that it has lagged rest of the markets by a pretty hefty margin. So from a valuation standpoint, the gap has widened, and kind of now it is in favor of China. Although there are few fundamental risk factors which are still at the play, but putting all of that together, I think the current market valuations for Chinese equities is kind of attractive enough in the emerging market basket. Moving on the currency front, by and large, we all have seen how US dollar has strengthened versus basket of global currencies on a year-to-date basis, and the strengthening has been pretty much stronger even across some of the safe haven assets. Say for example, Japanese yen, and that was largely due to the aggressive monetary policy tightening by the US Fed and the real rate gap widening between US and Japan. So not just Japanese yen, but if we look at some of the other currencies like pound, sterling, and euro, against all these currencies, dollar has appreciated quite a lot. Indian rupee, on the other hand, has depreciated versus the dollar, but this was kind of limited as compared to some of the other Asian currencies or the pack as such, because the Reserve Bank has been been outright in the market, intervening time and again to support rupee, and even the recent monetary policy statement during the press conference, the governor did emphasize on the fact that if required to basically bring rupee back to the mean levels, they would try and take certain actions and certain measures so that the rupee doesn't deviate too much from its mean. So rupee depreciation has been kind of limited, but if the intervention were to be limited from the RBI's end, then the depreciation could be much stronger from where it is right now. And with that, I'll just quickly talk about the four portfolios that we are offering out here to the investors. So we have got 4 multi-asset mutual fund based portfolios through our PMS portfolio management service platform that we have out here. And these 4 portfolios are basically linked to an investor's risk profile, keeping in mind their investment horizon and their risk appetite. The idea is to offer a multi-asset portfolio to an investor, which will help them generate wealth and protect capital from a long-term standpoint. We have got 3 broad markets, which is domestic equity, international equity, and fixed income. And within that, we have got large cap, mid cap, small cap. We have got exposure to international equities through US, Europe, emerging markets, and China. And on the fixed income side, we have got few other sub assets like short-term debt, credit, medium-term debt, long-term debt, and cash. And like I said, the idea is to basically offer a holistic portfolio construct to the investors and to the advisors, so that they are able to generate value from a long-term standpoint. And these strategies are basically based on our 4 pillars. And just to briefly talk about how we basically construct the portfolio, or how we take views across different markets and assets, is that we try and focus on 4 things. One is absolute valuation, second relative valuation, third contrarian indicators, and fourth fundamental risk. Now what we are basically trying to do is, when we are looking at absolute valuation, we try and look at the valuation of a market or an asset respect to it, to its own history, to get a sense whether relative to its history the markets are overvalued or undervalued. When it comes to relative market valuation, basically what we try and look at is that whether an asset is cheap or expensive relative to the other assets which are part of the opportunity set. Say, for example, where does India stand versus US, or where does India stand versus China, and so on. And the third pillar that we have is contrarian indicator, where basically we try and use a lens of a contrarian investor to assess if there is too much optimism or pessimism in the market, just to try and take a contra view versus what the typical view or sentiment is in the market. And the last one, which is the fundamental risk, basically helps us build in few structural issues or risk which are relevant for particular market, and then try and figure out what kind of impact will it have on our overall return estimate, and how much of that can basically be negated through some of the other factors. So that's basically the 4 pillars through which we build our views on particular markets. And talking about absolute and relative valuation in a little bit more detail, what you see out here is the 10-year valuation implied return forecast on real term basis. So this is adjusted for inflation. And what you basically see out here is the return estimate for different markets and assets as on July 2022 versus what it was, say, a year back, that is July 21. And interestingly, what you see out here is that the return expectation from each of these markets and assets has improved say as compared to what it was last year. Particularly in case of China, there has been a clear, and stark improvement that was largely due to, 30-40% kind of correction that the Chinese equities, particularly the tech stocks, which has seen a major correction. So the valuation has kind of improved quite a bit. Similarly, for Europe, for UK equities, and even for Indian equities, the return estimate has improved quite a bit as compared to what it was last year. Having said that, if we look at what's happening on the fixed income side, again, the overall attractiveness with rising interest rates has kind of improved for the emerging market debt and even for India fixed income by and large. But if we take a closer look at how the return is basically driven for each of these markets, particularly on the equity side, what you see out here is a return decomposition of the estimate that I just showed in the previous slide. Say, for example, in case of Indian equities, the return or for any equity market, the return is basically driven by three components. One is the total yield, which is your dividend and share repurchase yield. The second is the earnings growth component, and third is the valuation adjustment. Now, basically, what you see out here is that in case of India, the overall real return estimate comes out to be roughly around 3% but this could have been close to around 5% which is not at the moment because of this negative valuation adjustment of 2% that we are seeing. And what it simply means is that when we build in our fair valuation into the current estimates, what we are basically seeing is that markets are looking still expensive, and that's one of the reasons why the valuation gap is negative. If the markets were looking attractive, say for example, what we are seeing out here for China, the valuation gap would basically be positive. It means that the current market valuation for Chinese equities are lower than the fair value estimate. Whereas in case of India, or for example, in case of US, where the valuation adjustment is pretty negative, out here it still signals that the current market valuations are higher than the fair valuation multiple, which is basically taking out the return prospects from those particular markets. And if we look at the contrarian indicators quickly, the idea to look at this is to understand what kind of investor sentiment is prevailing into the markets. Is there too much pessimism, or is there too much optimism in the market? And to assess that, we try and look at three things. One is the flows, what has been the flows into the markets. Second is earnings expectations. What is the consensus street estimates, say for 12-year forward, 12-month forward to 3-year forward earning estimate. And then we look at the momentum, which is the short-term market performance ranging from 3 months, 6 months to 12 months and 18 months. So essentially, the signal which is common across three factors, or contrarian indicator, is that this sentiment is kind of moving more towards pessimism, which is kind of a positive sentiment for a contrarian investor, because a contrarian investor would try and get into the market when there is too much pessimism and get out of the market when there is too much optimism. So unlike what we have seen, say for example, if you look at the earning estimates, which were running pretty high, roughly around 22% or 24% until last year. Now again, given that the kind of downward earning revisions which are happening has basically seen some kind of improvement, and even the market performance by and large after a sharp rally that we had witnessed. Now given the kind of correction that we have seen on a year-to-date basis, the overall score is kind of improving on that front. So at an aggregate level, basically the signal out here that we are trying to gather and express is that from a contrarian investor standpoint, the situation is improving. It is turning out to be in favor, and the kind of optimism which was there until the end of last year has seen a reversal, and that kind of pessimism, little bit of pessimism, or more towards the neutral level is what kind of playing out at this point of time. And just to quickly talk about what we feel about the Indian equities at this juncture is that from a valuation standpoint, again, the markets are, if you look at the 12-month forward price to earning and price to book, given that we have seen a strong performance in the month of July, the PE and PB has again basically moved slightly above the long-term average, and the earnings growth projections which were put out around the start of the year has seen a major downward revision, given that whatever is happening in the global markets and the kind of impact or the spillover impact that it can have on Indian equities. So the earlier projections of 20 to 24% EPS growth for FY22 to FY24 is now scaled down, at a broader level to say roughly around 15%, 16%. So the idea is that one, yes, from a 12 months forward standpoint, where does the valuation look like, or how does the valuations are looking at a broader level? And the other thing to also try and focus is that from a long-term standpoint, how is it that the valuations are currently looking relative to its fair value? And just to explain this slide that you are able to see right now is that when we are looking at the valuation adjustment component, which I had shared in the previous slide for Indian equities, that was roughly around -2% for a 10-year period. So what it simply means is that on the one hand, we are basically seeing that the margins, the earnings and ROEs is something which will see a positive reversion and move towards its fair value estimate from the current low levels where they are right now. So that is a positive contributor to the overall return estimate. Whereas on the other hand, if we look at the market valuation, it seems that the markets have by and large factored in a lot of these positives, both at the macro front and both at the on the fundamental front, and that is one of the reason why the markets are kind of looking expensive as compared to its fair valuation multiple, and that is why we are seeing a negative P reversion impact. So all put together, the basic sense is that the markets are kind of still looking slightly attractive, slightly expensive when it comes to Indian equities. But when it comes to the international equities, the attractiveness has kind of improved, particularly for Europe and emerging market, or China in particular. And this is how, currently we are placed for, say, for example, the aggressive portfolio, the equity heavy portfolio that we have versus the neutral or the benchmark allocation. On the domestic equity front, we are underweight roughly around 2 to 2.5%. We are underweight US equities as well. And this underweight allocation is kind of filled towards emerging market, particularly China, to Europe. And on the fixed income side, we have got a favorable view on medium to long-term debt, where we are also kind of overweight. So the idea is that the extra weight that we are carrying currently on the fixed income side is something that we would keep a close eye on, depending upon the evolving market dynamics, and if there are any relative attractiveness, and not just for Indian equities or for even for global equities, we would basically actively take those calls to try and figure out where we can basically generate a potential alpha as compared to the benchmark. So that is what I intended to share today, and with that I'll just kind of pass it on to Resham to talk about his views on the markets.
Yeah, hi. Am I clearly audible?
Yeah, Resham, you are.
Okay. Let me just share my screen.
Sure.
Okay. Can you guys see my screen?
Yes, it's visible. Maybe if you want to put it on full screen. Yeah, that's perfect.
Yeah. Okay. So what I am planning to do is just share the overall the thought process of how we run small mid-cap portfolio. And obviously, what I'm planning to do is, and I'm sure you might have gone through this earlier, and I'm sure you might have gone through this earlier. The fund managers have put out, and it's available on our website as well. What I've done is basically try and important points I've highlighted here. DSP Small Cap and Mid Cap Fund are the two funds which I look at along with Vinit Samre. And these are some core philosophy and principles which we have especially to manage our funds. And there are qualitative aspects and then there are quantitative aspects. But the first and the foremost basically try and understand the business, and this so obviously some of our very of the scalable.
Resham, sorry to interrupt. I think there seems to be some audio lag.
Okay. Is it any better now? I don't know.
At the moment, it's better. Yeah.
Okay. So as a principle, both funds, mid cap and the small cap fund, obviously we will have a top-down view of how economy and various sectors, and based on that we will allocate our money into various sectors. But prima facie, our objective is to identify good companies and good promoters and invest into them. That's how we think about it. And that's where the scalability and the durability of the company comes into picture. Obviously, some of the important factors we'll discuss on the financial parameters like ROC, ROE. And being a smaller company's governance plays a very, very important part for most of these companies. And another important aspect is the thing which we have seen in the last few years, where most of the sectors and companies have gone through their own cycles, and those are deep cycles. How companies basically manage through those tough times, and basically the survival part and the ability to grow are the more important parts over there. And lastly, the self-discipline also at the same time is important. As Chintan has explained in his slides, wherever there are periods when valuations are on a higher side, and then there are periods when valuation corrects. So we have to be disciplined in those aspects and try and reshuffle and rebalance our portfolio accordingly. What is more important is to avoid mistakes. So what we are wary of is the capital misallocation, which are typically done by companies over a long period of time. And we want to avoid those mistakes in investing in those companies which misallocate the capital and don't invest in a right means. So that's very important. Second is disruptive competition. So sector might be good, company might be good, but what happens is that a new player comes in and try to disrupt. We have seen a lot of companies suffering because of this new age startups, where the economics in the initial few years are very different from a typical listed universe. Similarly, companies which are very highly regulated either by government or by various other international laws, we try and avoid them because they can be very unpredictable in terms of their earnings. And lastly, very complex organizational structure, because it's very difficult to understand what they are doing across their companies. So those are like important principles when we invest and look at various companies. These are the three broader buckets in which we try and evaluate companies. One is the business model, another is management, very, very critical, especially in the mid-cap, small-cap company. And obviously, valuation also plays a very, very important role. So a mixture of all these three things, that is business model, management, and valuation, gives us the universe for us in terms of the companies that we want to invest in. Before going to the qualitative aspect, this is the investment framework which we have, where we have defined quantitatively that these are the type of companies which we typically invest into, and these are for the non-financial companies where we say that companies having an ROE of more than 16% are the companies where we want to invest in. Companies which are growing at more than 13%, which is basically indicating that growing at a higher than nominal GDP. Companies where the margins are on an improving trajectory, showcases their pricing power and operating leverage. Companies which are paying taxes, because a lot of companies show their profit by having a different kind of structures. Companies which are having a very high earning variability in terms of volatility in earnings. It's very difficult to gauge and predict how they're going to behave. So we avoid those kind of companies. So less than 100% is basically trying to say that earning variability should be lower. Payout should be at least 15%. Less leveraged companies. Companies generating free cash flow. Valuation where they justify the ROE and the growth which they are delivering. And obviously some of these important parameters from forensic perspective also, like companies having a very volatile receivable days or payable days or inventory days, basically says that there is something in the business model which is changing. So we try and investigate, but that gives a good understanding whether the business is stable or quite fluctuating in a way. These are some of the parameters for financial companies in terms of ROEs, PAT growth, gross NP and all. This is what the fund looks like in terms of various parameters. We have not taken 22 weight as of today because a lot of annual reports are still coming. Maybe in the next few weeks we'll come out with this. And we have taken a weight which is, the numbers which are for FY22. As you understand, the FY21 numbers are all over the place because of COVID. But this is how our various parameters looks like in terms of ROE of the fund, PAT growth, and various other aspects. So we try and make sure that 60-70% of our portfolio remains in this bucket, which showcases that the quality of the portfolio remains quite good. There will be 20-30%, maybe sometimes 15, sometimes 20, depending on the situation. There will be companies which are going through the transition phase where we feel that this will come into this framework. Currently, they are not. So we might invest into those companies also, but that will be relatively smaller proportion of the overall weights which we assign. These are few core principles when we invest or build our portfolio. So obviously, as I explained, bottom-up approach and alpha mindset is how we approach the portfolio. Second very important thing is we try and look at holdings as if they are owning those businesses, which I'll share in the next slide, how our turnover ratio is of our funds. And typical holding period for our fund is like 4 to 5 years. 5 years for small cap fund, as you know, the liquidity factor also comes into play there. So we try and build stocks where we want to hold for 5, 7, 10 years. Third very important thing, obviously now under the SEBI regulation, everyone is true to label, but we are saying that, for example, in small cap fund, most of the stocks which we buy incrementally are all small cap stocks. They graduate to mid cap and then we slowly sell them rather than buying, or for example, in small cap fund, we hardly ever bought any large cap stock. So we try and give full exposure to where an investor wants to invest in. Similarly, as you know, I mentioned, we have this investment framework. It's a 13-14 page document where we are trying to explain our thought process, our philosophy. So that document becomes a very important document for us. And investor can then align with how do we think when we invest into the company. And obviously, investor first approach, very, very critical. Being into the fiduciary responsibility, we have to be very, very vigilant and very honest to what we are doing. And in the past, as you know, in small cap fund, there are instances when we thought the valuation has peaked and we don't want investors to invest in incremental lump sum money. So we have stopped our fund, and we have later reopened it for SIPs, and then in March 20, actually, we reopened the fund for lump sum as well. So whenever we feel that valuations are stretched and we are not finding enough ideas, we would like not we will indicate to the unit holders that incremental investment may not be very optimal. And lastly, again, as per the SEBI regulation, now 20% of our money is invested into DSP schemes. But as a philosophy, before this regulation itself, all of our incremental money is being invested into DSP funds only. We can't invest in stocks, and all our money is invested into DSP schemes only. This is what I was talking about, both the funds. If you look at, this is for mid-cap fund, where we have a turnover ratio of 28%. This has slightly gone up, but on an average in the last few years, you can see our average holding period is like 3 to 4 years. And similarly, in small cap fund, our average holding period is like 5 years, more than 5 years. 18% is the turnover in the small cap fund. So the most important aspect when we invest into small cap, mid cap companies is patience. I have actually presented specifically on patience, giving few examples, because that will be more interesting. How do we think, how we go through our journeys of investing into various stocks? So I'll go through that as well. And these are beyond numbers. These are very important stuff for small cap companies in terms of proven track record. So these are some of the examples where they have very solid. It's wrong, not Coromandel Engineering, it's Coromandel International. But so these are the companies which has a solid history of proven numbers, and so that becomes very, very important for us. Capital allocation, as I explained initially, integrity, passion of the promoters, and this comes with experience, with time. When we try and understand management, how consistent they are in that thought process, that becomes very, very important. And some of the important stakeholder relationship also. These are some of the unique companies which I mentioned, where they take a lot of care about either, for example, KPR, take care of employees, some almost 25,000 plus girls studying as well as working, a unique model. More than 40,000 girls cleared their graduation working in the company. Or for example, Narayana, the way they provide affordable healthcare, or the way Coromandel in their fertilizer factory, as you know, which is more polluted in nature, but they have created almost an artificial wetland in their factory or near their factory. So those are the things also which we take into consideration while we invest into companies, how good they are taking care of various stakeholders, not just shareholders. Because if they do good for all the stakeholders, ultimately shareholders will be benefited out of it, and governance standards. And some of these things I have already explained, companies which we want to avoid: corporate governance issues, capital misallocation, highly cyclical industry, lot of related party transactions, complex organizational structure. These are the type of companies we don't want to put our or a very high proportion of our weight into it. Typically, this will have a very minimal weight in our portfolio. And a few examples which we have. And we have a specific dedicated analyst for forensic. And now we have a specific analyst for ESG as well. So those are specific things. This will be very interesting because I've tried to give few live examples. How do we think? And with so much of information already available to all of us through various means, sometimes it becomes noise also. And hence, one of the key factor which helps in generating alpha is patience. You invest in a company and sit through that company over a long period of time. And I'll try and give you examples around it. Initially, I'll try and give few positive or which examples which has helped us in our portfolio. And you can look at some of the stocks like IPCA, SRF, Atul. These three stocks specifically, we have been holding for almost more than a decade now, and we have been adding them at various point of time. We have book profit also, but you can see having invested in these companies over a longer period of time has helped us. Similarly, Kalyani is one example where we have been investing over last few years. Obviously, it has not yet rewarded, but we have been patient here as well in terms of giving time to the company, because whatever they are doing is right. Maybe market may take some time to see the fair value over there. But just trying to give examples that holding over a longer period of time does help. And obviously, these are the important principles for those companies. They should be scalable business. There should be a larger opportunity. Cash flows and ROC should be strong. Then only you can hold for a long period of time. Even during pain period, you can continue to hold. So this is one example. Like if you look at SRF, it has gone through a massive transition in the way it has operated over a period of time. So if you look at FY 11-12, when we actually entered this stock, the chemical segment was just 21%. This is still FY 20, but if you look at now, this number is more than around 55-60%. So there has been a massive change in the way companies capital employed has changed, and that is visible in the chemical segment revenue, which has now become more than 50% of the company's overall revenue. And obviously, because of this, there has been a massive re-rating as well as earning growth, which has come in. So you look at all the numbers. These are the periods when actually company was investing into chemical business. The ROEs was actually continuously coming down. So this was kind of painful period because stock might not have reacted during this period of time. And then there was this period when actually they started improving or showing improvement in their ROEs, ROCs. Similarly is the capex. You look at 12, 13, 14. These are the periods when actually they were investing more than what they were generating in terms of operating cash flow. So we have to see where they are investing, what they are investing into, how those businesses are, and that actually helps us in taking and enjoying a larger journey with those companies. And obviously, during this period, the debt went up. The net debt to EBITDA also was at peak during 14. But as they kept showing the growth in the chemical segment, most of the things started improving for them. This is another example, Lipka, very strong, very highly focused on cost element. And they faced this challenge during 2014, during this US FDA challenge, and which compressed their margins massively. So you can look at this margin column here, which was around 25%, moved to 11%. 25 to 11%, and because in this period there were a lot of US FDA related costs which was sitting. As of today, company doesn't have any material US business, but what they have done is they have absorbed those costs and try and work on their overall business model, and over a period of time their remaining business, for example the domestic business, continue to grow at a very strong pace, and over a period of time their ROC, which was depressed, started improving. So their margin also improved, and then their ROC, ROE also improved. Another example is this Welspun India, Dhanuka, Suprajit. You can look at these are companies where they have seen cycles, but if you remain patient, if you think your business is good, then eventually they tend to benefit. Again, this is the cyclical nature of agri business. Dhanuka is into agrochemicals, and you can see depending on the monsoon cycle and how the sector behaves, it's very cyclical. But if you look at over a longer period of time, 10 years, 15-year journey, very good ROEs and very good growth numbers as well. And suddenly after a lull, stock does well. So it's very important that you sit through this pain period, not only just sit through, but you double down your position if you have a conviction in those companies. Similar is CRM. Again, I give an example here. Then some not so good examples also, just to be fair. You look at this company, Aarti Drugs, we have been holding since 2014. Nothing happened in this company. And then suddenly their profit also improved, stock price also reacted. And then there is another company, Majesco, which we have been holding since last many years, from 14 to almost 20. We sold actually over here, and you can see what happened after that. So there is an element of luck as well sometimes, because you don't know how the cycle will play out. So you have to be very vigilant in when you buy or sell. But we have remained very true to our process, rather than predicting those one-offs which can come through. And that's not the way we operate. Similarly, let's say, for example, K1 Kiran, we have given a lot of time to the company. We were holding from almost 2010-11. Stock did well, but growth was missing in this company. And finally, we decided to sell this company. We made some profit, but it was a pain period for us. And then obviously, stock further corrected from those levels. Similar is Navkar, for example, which we have bought, and then obviously they're messed up with their balance sheet. And obviously, they have also gone through that painful period. So patience, most of the time it helps, but many times it gives us a lot of pain as well. So we try and exit our position after waiting for a long period of time. If we feel that they are going through regulatory issues, for example, Navkar, there has been this direct freight, which has started direct port delivery, or for example, capital allocation misallocation, or our investment thesis doesn't play out. So those are reasons why we exit a particular stock. So that is one angle of generating alpha, which is try and be patient with the company, but at the same time, you try and take a very hard calls if your things doesn't pan out the way you have anticipated. This is another important aspect when we invest. As mentioned, we invest for a very long period of time. So what are the things which we look for in those industries and companies when we invest in? So I'll just explain few important graphs over here. So for example, let's say cement, if you look at 10 to 20, the industry has grown at almost 8% in terms of volume. India per capita income, per capita cement consumption has also gone from 164 kg to 237. But the global averages are more than like close to 520. So we have still an headroom for growth. And hence, so basically what has happened in the past and how global emerging economies plus the developed economies, how are they doing, are very important part or important factors for us to determine where we want to invest in. So cement, for example, is a very good space to invest in. It's a very difficult sector. It requires a huge amount of capex, huge gestation period, because it requires 3-4 years, 5 years to put up your plant and then generate a cash flow out of it. So not an easy business. Tiles, for example, have grown at 9% CAGR, and India is almost like 1/5 of where the global averages are. Similar is PVC pipes. So these are the numbers which gives us an insight that, okay, these are the sectors. And sometimes you may feel that it might trade at a slightly more expensive valuation than its historical level, but it justifies because the kind of growth journey this particular sectors and companies can see through. Similar, for example, AC companies, 12% CAGR, significantly underpenetrated compared to global, or for example, China here. Refrigeration or refrigerators, for example, it's just 42% penetrated versus 59% in China. Or for example, washing machine. So these are the things which gives us an insight on various sectors. I have just tried to give few examples over here. And then we look and deep dive into companies. So for example, Kajaria, if you look at 12 to 20, their market share in the tile segment has moved from almost 5% to 10%. And during this period, their ROCs have always remained more than 15%. So they maintain their quality of earnings, and at the same time, they have gained market share. So those are important aspects. Similar is APL Apollo, which is into pipes. And they have also increased their market share in the kind of pipes they operate in from almost 12% to 40%. And again, ROEs they maintain about 15% across cycle. Across cycle is more important because even in bad years, their earning might be a little lower, but they don't compromise in terms of their return on equity. This is just a snapshot of how various companies in our portfolio, how the PAT growth has been and how the market cap growth has been. So you can look at Nifty, for example. The PAT growth and the market cap growth over the last 10 years is close to 7%. So the PE one can expect to remain same over here. But what has happened to some of these market leaders, all these companies which I'm talking about are available only in small and mid cap space, but they are still market leaders in their particular domain. So you will not be able to play some of these themes in other market cap, like in large cap, you will never be able to find such companies. So that's a unique proposition which we bring into. So for example, Kajaria, PAT growth has been 22%, Supreme 12%, yes, Atul 28%. And in most of the case, you can see the market cap growth has been slightly higher than PAT growth because they have proven in terms of their earning growth ability being much better than Nifty. And hence, there has been some P re-rating also, which has happened during this period of time. And this is just to give a snapshot, and you can just look at one aspect here. For example, paint industry is a 4 lakh crore industry, and market cap of paint companies put together is almost like 10x of that. But if you look at some of the other categories, because paint have become large, and these are large cap companies, but some of these other companies which you think about, washing machine or refrigerator or mattress or PVC pipes, they are equally or probably slightly lower in size, but the market cap is significantly lower. So the another theme along with penetration, which is also playing out since last few years, is the unorganized versus organized. And that's also clearly visible. So as market as the organized players become much more larger, they try and gain more share from unorganized. What will happen eventually is that the market will get consolidated, like what we have seen in case of paint. We have already seen some instances of that happening in pipes, or for example, happening in ACs, or for example, happening in structural tubes. I have shown APL Apollo. So some of these themes are already playing out, might be in the transitional phase over here. But this will also help in consolidating and making sure that they make consistent margins over there. This is just an example of some of the companies in our portfolio. They are market leaders in their particular domain. So for example, Atul, probably in almost 6 or 7 large chemical streams, they are world's largest. APL Apollo, as I mentioned, structural tubes, they are the largest in India. Ratnamani stainless steel pipes, largest in India. Nilkamal molded plastic furniture, largest in India. So some of these companies are largest in their particular domain. So this is how we want to play in our both mid cap and the small cap funds. And yeah, that's what I wanted to just share my thoughts of how we think about and how we invest into various companies. Or I might have taken slightly longer time, but yeah.
No problem, Resham. That was pretty much insightful. And thank you for running through the investment framework and the style of investing which is being followed for both of these funds. Now, there are few questions from the participants, and maybe before that, if I can also post in a couple of them. So, the mid cap fund in particular has been, going through a rough patch, and, it has seen underperformance versus the peers as well. Can you please help us in understanding what has been going wrong with the fund, and what are the key things that you are trying to put in place or fix so that the performance would basically see an improvement of sorts?
Yeah, so you are right. The fund has been slightly underperforming since last almost, let's say, 18 months or so. I'll just put up one more presentation which we have shared recently. Just a second. And I'll just showcase few slides and then probably I'll explain probably slightly better. Not able to share, I don't know. There is one PDF which is open, but I'm not able to share it. Can you see my screen?
No. Maybe if you just want to talk through those.
Okay. I'll just talk through. So basically, if you look at our fund, there are phases in a fund. So if you look at our journey over the last 7-8 years since let's say Vinit is managing the fund, during 2019, 20, and a good part of 21, we were actually doing quite well. And before that, if you look at 17, 18 period, actually the fund was not doing well. So if you look at the way stocks also goes through the cycle, the fund also, because more or 70-80% of our fund typically, or the stocks remain same in the portfolio, they have done quite well a period before that, and then they are going through their consolidation phase. So that is number one. Second is that obviously there have been a few in a way we can say misses which we had in our fund. So for example, midcap IT, we have been little underweight in the fund. We had a few stocks, but some large caps over there. So not having midcap IT during this last 18 months have hurt us. And you have seen the kind of re-rating which has happened in the stocks. Obviously, we have not chased them in that momentum which was happening. And the last 3-4 months have been good for us because we were having underweight, which has helped us because most of the stocks have corrected by 40-50% from the peak. Similarly, some of this capital goods infra names, we have been little underweight. Again, based on what we feel in terms of growth versus valuation, some of those companies where we are not very comfortable in terms of valuation has done quite well and have been further re-rated. But yeah, that's the journey. So that's the second. I would say the misses. Third, very important element is some of the stocks in our portfolio. If you look at, we have almost 19-20% ROE of our portfolio. So the quality of the names are quite good, and quality names have some are the names which has not done that great in the last 1 year. So I think some of those companies are coming back, already showing good traction, and hopefully some of this lost alpha could be bridged in the next maybe few years if our conviction and our thesis plays out.
Okay. So there are a few common questions from the participants. Maybe I'll just pick up those first. So one is, what's your sense on the mid and small cap valuations at this point of time? And the other thing is the kind of do you foresee a major impact on the margins and the ROAs for the small and mid cap companies given whatever is happening in the global markets on the commodities front and so on? And where exactly are you seeing attractiveness at this point of time?
So yes, at an aggregate level, if you look at mid cap, small cap space, they are on a higher side in terms of valuation. But there are opportunities available within the space, and I can talk through a few of those themes. But just related to that is your second question. Obviously, we are going through difficult period, COVID, and then now inflation and rising interest rates, depreciating rupee. Most of the commodities are now softening, except energy, whether specifically coal and crude hasn't come off to the extent the way, let's say, other metals and some of the agri products have come down. But so generally we are seeing mixed kind of situation right now on the economy side. But specifically coming to companies and themes, so I think one very important thing is that last, let's say, few quarters, consumer names have not done that well because the branded companies typically take time to pass on the price to the consumer, but they pass on eventually. And whenever the commodity prices soften, both demand as well as margin both comes back. And possibly we are already seeing some signs of that happening. So for example, if you look at palm oil, which is a very key ingredient for a lot of FMCG companies, which has gone through some pain, but now from peak, the commodity has corrected. I'm just giving you an example. Or for example, the way the dairy prices, for example, milk prices, the way the procurement prices have gone up for the dairy companies, they have passed on, but the pressure on margins are visible. And with the lag, those margins comes back. And that we have seen over longer history. If you look at on an average, they come back in terms of margins. So one theme is clearly the consumer names could do reasonably well. Second, within consumer names, I think consumer names where they have seen a lot of pain in the last 2 years, especially in terms of demand. So for example, let's say if you look at a mall company which is operating a mall, people have stopped going to malls, started ordering online. Obviously, a lot of them are still ordering online, but people have in general started moving out, whether it is let's say hotels or malls or aviation companies. So those things are coming back. Obviously, in the last 2 years, they have bring down their costs significantly. At the same time, now they are seeing growth. So, or a theater company, for example. So you look at some of these names in the consumer pack, which may see some improvement theme over there. Similarly, for example, themes like agri, very, very critical, not only just from agri perspective, but generally from an economic perspective, because this will be the fourth back-to-back good monsoon year for the country. It has, if you look at, I was just looking at last 40, 50 years data, this has never happened. Fourth back-to-back good monsoon. And the reservoir levels across India is quite good. We are seeing almost historical averages, almost 20, 30, 40% higher levels than historical levels. So this bodes well for almost 50-60% population of the country, directly and indirectly, which in turn results into a very good situation from consumption perspective, from income perspective. So those are interesting things for us. And at the same time, the agri commodity prices have softened, but it is still much higher than what we have seen, let's say, 2 years back. And at the same time, some of the input costs, for example, one of the key input costs for farmers is, let's say, fertilizer. And you can see fertilizer subsidy, which used to be 70,000 crore, is now 250,000 crore. So almost all the pain, which typically a farmer should be taking, government is actually taking on their head. So in a way, there has been a wealth transfer which is happening from a general economy to a lower strata of the economy. And the classic example is you should be reading stuff like what's happening in neighboring countries, like say, for example, Pakistan or Bangladesh or Sri Lanka. They are suffering massively. So I think we are into a very good situation if you think from what some of the other peer countries are into. And that gives a lot of hope to us that we are into a much better shape than what's actually happening and what we are reading on the global arena. So these are some of the good themes where we are very, very positive on.
Okay, great. I think we have exceeded the time available. Maybe just before we kind of wrap up, just a couple of things to mention. So we are basically hosting our 12th Morningstar Investment Conference on September 20th and 21st. So I would request participants to visit our website and look out for more details on that, and register for the conference. It would be good to see or meet everyone in person. This will be the physical format this time with the conference. And some of the questions which we couldn't answer during the session, we will try and send out responses to those questions through email. And thank you very much, Resham, for taking out time and sharing your views with the participants. And thank you everyone for joining us today for this particular webinar. Hope it basically added value to your practice as such. So thank you very much.
Thank you.